MBMG Investment Advisory, 29th of January 2021, Fun and GameStops. I'm Paul Gambles. The MBMG Investment Advisory team decided to put together a brief explanation of the unusual activity in capital markets in the last few days and weeks. Some people are describing this as unprecedented, but we're not so sure about that. What we do know is that some assets have been behaving in a mathematically extreme way for some time now. We recently sent out this chart showing the spurious correlation between the price of Bitcoin and the price of avocado a couple of years ago. More recently, Bitcoin and Tesla have exhibited high correlation. Since the beginning of August, the price of Bitcoin is up by just over 200%, whereas the price of shares in Tesla is up by around 180%. In this case, we think that there may be some common factors that are driving this. And we also see something similar as being maybe one of the factors behind the rally in GameStop Corp, a US listed stock with the ticker symbol GME. GameStop Corp is a retail business. It sells video games out of 5,000 stores at malls across America. This is a difficult business model. It was facing challenges before the pandemic, and these have become exacerbated during COVID, during the lockdown. Although there are some people who believe that GameStop is potentially capable of turning around. These include Ryan Cohen. Ryan was the former CEO of Chewy Inc., which was an online pet food retailer. And as Matt Levine has noted, well, if you can sell pet food online, you can sell video games online. GameStop actually does sell some video games online, but really it needs to do a lot more of that and a lot less of in-store sales. Now, Ryan Cohen's investment vehicle actually started buying shares in GameStop last August when the price was less than $10 per share. It now owns around 13% of the company. So in the space of a couple of months, Ryan Cohen has tried to bring about some change within GameStop. And I guess, what we've seen is we think that a money-losing traditional retailer in a dying business during a pandemic has somehow been sprinkled with online dog food fairy dust, and as a result is trying to position itself as a dynamic e-commerce leader in a rapidly growing segment, i.e. gaming. Now, clearly stock buyers bought into this good news, quite literally, and from a low point of just over $17 per share at the start of this year, GameStop shares increased, but they doubled in value within 24 hours on January 13th, and then they repeated that again on January 22nd. Earlier this week, it peaked, for now at any rate, at around $380 a share, before falling back to $112 and then rebounding up again to $193. Remember, this is a stock that just 4 weeks ago was $17 a share. These are extreme moves. We don't think they're just justified by enthusiasm for the turnaround story. There's been a coming together of factors that have made this a perfect, or imperfect, depending on your perspective, storm. We'll try to explain these. GameStop has clearly generated high levels of interest from individual investors, often known as retail investors as opposed to institutional investors. I realize it can get confusing when we're talking about retail investors and we're talking about a retail business, but these are really two very different things. Now, GameStop very quickly became what was called a cult stock because of Ryan Cohen's success with Chewy. And Michael Pachter from Wedbush has said retail investors are confident that Ryan Cohen can implement multi-channel initiatives that will materially grow their earnings, whatever that means. But firstly, let's take a step back and let's look at the role that retail investors play in US equity markets. From 2010 to 2019, so-called retail investors seem to have had a marginal impact on the pricing of US equity markets. In fact, they actually sold over $1.5 trillion of shares, more than they bought during that time, more than 100% of the net activity in US equity markets was actually companies buying shares, typically buying back their own shares because they didn't have anything better to do with their cash. So over $17 trillion went into equity markets from companies buying back their own shares, whereas individual investors actually took money out of the equity markets over that period. So clearly something very different must have happened with GameStop. Well, the first thing that we can see is that the proportion of American adults who invest in equity markets hasn't markedly changed. It's been around 55%, plus or minus 3%, for that entire decade. So the proportion of adults who invest in equities in America isn't different than it has been during the last 10 years. A group member tells me that there are basically three types of member, three philosophies that dominate Wall Street bets. The first of these is very informed, very sophisticated investors who understand capital markets, the mechanics of these, and you might say they're using the discussion group to enact their own calculated risks. It's fair to assume that this is by far the smallest of the three groups. The next group is described as financially disenfranchised. People who maybe feel they lost everything in 2008, they didn't receive any help, they saw the guilty go unpunished, and they now see exploiting the discussions on Wall Street bets as a way of extracting revenge or extracting justice from the system. They understand that they're taking risks, but they feel that this is their only way to get even. The third group was described by my friend as people who believe that bankers and the system suck, so they want to destroy it. This is a kind of extreme financial drain the swamp, hang the consequences, hang the bankers too. Now, I have to say, I can sympathize with groups 2 and 3. I just don't know that this is the right way to extract socioeconomic justice. And my feeling is that group 1 will ultimately do very well from this, but I'm really not sure about groups 2 and 3. So I can't help wonder if Wall Street bettors need protecting from themselves and protecting from each other. So I think Matt Levine here does a great job of explaining how the fire started. I think what we'd add is that whenever somebody starts a fire, there's usually other people who will turn up and try to fan the flames. Now, we're currently worried about the level of manipulation in many assets right now. Big tech, small tech, unprofitable tech. I guess the one that we keep coming back to is Tesla and the effect that Elon Musk has on markets, on all sorts of securities. There's a well-known story that the price of shares in a company called Signal Advance Inc., the price of its shares shot up over 5,000% after Musk tweeted something about an unrelated app called Signal. Now, the price carried on increasing even after extensive news coverage and explanations that Musk was talking about Signal app, not Signal Advance, two totally different things. Even 2 weeks later, it was still 900% higher than its pre-Elon tweet price. We've seen a similar thing with GameStop. In Australia, a resources company that just happens to share the same stock symbol, GME, has increased in value significantly. For anybody who doesn't know, stock symbols are unique to a stock in a given country. So you can have a GME symbol for GameStop in Australia, in America, and you can have GM as a resources company using a ticker symbol GME in Australia. So that again has led to the same situation where the combination of celebrity endorsement, confusion, chat room hype, and we think that these are also the same factors that have propelled Bitcoin and other cryptocurrencies, which are essentially worthless, to stratospheric prices. But how does this actually work? One aspect of this has been commented on by Epsilon Theory's Ben Hunt, who says, Note that retail investors tend to prefer things that are cheap and things that have significant leverage. And we can see this in the explosion of activity in penny stocks, in small stocks, and also in stock options. So essentially, this change in behavior has seen investors buy stocks and other assets directly by themselves rather than through brokerage accounts. It's seen an explosion in the influence of discussion groups, and it's seen a tendency towards highly leveraged assets. So after the likes of Robinhood started offering nil commission option contracts, the volume of small lot option contracts, the ones that retail investors might buy, absolutely exploded. Let's just backtrack a minute and look at option contracts. One of the most leveraged ways to invest in stocks is to buy options. Stock options are a financial instrument, what's known as a derivative, that give investors the right to buy, if it's a call option, or the right to sell, if it's a put option, at a pre-agreed price within a predetermined date, known as the expiration date. So this can provide extremely cheap, but also in some ways risky exposure. The premium to buy such an option might be a few percent or even fractions of a percent of the cost of the stocks themselves. But if the target price isn't achieved within the expiration date, the options lapse with nil value. Now, the use of options in effect leverages exposure by possibly hundreds of times. So the effect of, say, 500,000 Reddit readers turning up with $100 each to buy GameStop, that would be noticeable. That would amount to $50 million in inflows. Now, in December, $50 million would have been 77% of the lowest daily volume that was traded in GameStop on December the 16th. It would have been about a tenth of the volume that was traded on the busiest day for GameStop, which was also just before Christmas. So depending on the timing, $50 million would have had some impact, but it was unlikely to be life-changing, especially if the buying activity was spread over time, as you would expect the actions of 500,000 individual investors to be. One thing we need to take into account, though, is that the impact of acting on a discussion group is very likely to compress this kind of action, investor action, into a much shorter period of time. It's also potentially likely to make it self-reinforcing, in that if other group members who didn't act see the impact if the stock price starts to go up and they then jump on board, this then becomes self-reinforcing. The use of options, however, will have hugely magnified this, because this will have created what's known as a gamma squeeze. To understand this, if we look at the option contract for 100 shares on January 19th of this year, that the shares were changing hands at around $35 to $40, and the counterparty who wrote the option contract would typically have only bought around 40 shares. So we have an option contract for 100 shares, but it actually only leads to around 40 shares being traded. Within 4 days, because the price increased to the target price, that 40 shares would have increased to 100 shares at prices of up to $50. This is the gamma squeeze. I was going to try to write about gamma squeeze, but fortunately for all of us, I think Tracy Alloway beat me to it and did it better than I've done. So I've stolen Tracy's explanation here. But the key here is that the effect of so many options going up so rapidly creates a squeeze where the option counterparties, the market makers, the big institutions who are the ones who actually sell the options in question to the investors, they have to cover the risk that the shares are going to achieve the target price by buying more shares as the option date becomes closer and as the share price moves closer to the target price. This effect becomes exponential. It has an outsized impact on the price, which is exacerbated in a kind of self-fulfilling cycle, in that the price increasing probably causes more Reddit readers to go out and buy more options, which creates more demand for the stock, which pushes the prices higher, which squeezes the gamma even further, causing more stocks to be bought, which pushes the price higher, which squeezes the gamma further. Basically, we end up with an ever decreasing gap between stock price and stock option target until the option contracts are filled with the same number of stocks being bought as the nominal contract. So on our 100 share contract, it resulted in 100 shares being bought, even though the outlay from the investor was much, much lower than that. On top of that, we have another phenomenon at work with the GameStop share price, and that is that while many of the retail investors were buying into the Ryan Cohen and Chewy recovery story, many other investors, including hedge funds, had taken a very negative view on GameStop. And because of that, there were a lot of short sellers of GameStop. Basically, investors who sell shares that they don't have. Therefore, at some stage, they have to borrow them and promise to return them later. To borrow shares, you have to pay a fee and you have to post collateral based on the value of the borrowed shares. And you'll generally have to return the shares if the lender asks for them back. When the stock price goes up, short sellers get squeezed because their borrowing costs increase, they might have to post more collateral, and they face the risk that the lenders might ask for their shares back. So some short sellers might end up capitulating. They might decide they don't want to face that risk. They don't want to post more collateral. They don't want the higher costs. They may change their views on the investment hypothesis that they had. So therefore, they'll close their positions by buying the stock. Now, that creates yet another feedback loop because, of course, they're buying stock, which pushes the stock price up. And as the stock price goes up, more and more short sellers might give up. And again, we have this feedback cycle loop. This is a greater problem the more crowded a short position is, i.e. the more shares that have been sold relative to the total number of shares in a company. You don't want to be short a stock where there's a high proportion of short interest. Now, typically that might be defined as, say, 10% of the issued shares. Very high interest might be 20%. History is replete with examples where short sellers have been squeezed. A lot of people believe that VW was saved from bankruptcy by a short squeeze in 2008 that propelled VW briefly to become the most valuable company in the world. My colleague Jim Fraser has pointed out the parallels between GameStop and the Northern Pacific Railroad short squeeze of 1901, when a takeover led to shareholders having created what's known as a corner when they controlled pretty much the entire free float in the company's stock. So in the case of GameStop, the short sellers weren't just more than 10% of the company stock. They weren't just more than 20%. At times, they were more than 100% of the company's issued stock. More and more short sellers piling in heavier and heavier bets as the stock price continued to go up. So GameStop only has around 70 million shares in issue. At times, well over 70 million shares were sold short. So companies like GameStop, also cinema chain AMC, which has undergone a similar but less dramatic story, and other companies, BlackBerry, Nokia, that have all experienced something similar to this in the last few weeks. GameStop, AMC, they've managed to raise enough capital to ensure their own survival when this was actually looking quite dubious. Hertz did the same last year. When they did that, it was described as a fraud in plain sight, or not quite fraud, but fraudish. The bottom line is this is an inefficient allocation of capital that benefits these companies, and it also benefits anyone who's got a vested interest in them. So it's really a game changer for GameStop. It might also change the way that hedge funds do business, but Samadrangi of Kerrisdale, who's a hedge fund manager that we admire a lot, he actually sees these events as creating greater opportunities going forwards. He says, I don't think we've ever been trolled or targeted as much as now, but that's just part of what we do. It's great for us if you get a ton of investors that crowd into a name on the long side and they don't know what they own. When we share our research, they're going to pay attention to that, and there'll be a ton of volume. There's going to be a real debate, and it won't just be a bunch of sleepy mutual funds. We don't have a problem with that. So there could actually be much greater opportunities going forwards. The final thing, is this legal? Well, we wouldn't be allowed to operate the way that Reddit groups do, but then again, we wouldn't want to. In many ways, this story is as old as the hills. Stock prices have been manipulated. In the US, the SEC was created in response to the activities of stock manipulators like the so-called radio pool that manipulated the price of RCA stock for their own benefit. In Thailand, these practices used to be widespread. In both cases, regulation was enacted to protect investors. And if that needs to be done, in this case, hopefully it'll be done before too many discussion groupers get hurt, whatever their motivations are, political or otherwise. It strikes us that this is the kind of thing you do tend to see in late stage bubble markets. And maybe if GameStop actually brings an end to the kind of market gaming that we feel Tesla, SoftBank, cryptocurrencies are involved with, then that would actually maybe be the best outcome of all if it stops more people getting hurt in the future. Thank you for listening. This has been a presentation by MBMG Investment Advisory. Any thoughts or questions, please don't hesitate to email us at info@mbmg-investment.com.